Look at the financial district of New York in the 1920s. It was an ecosystem overflowing with capital, drawing retail investors eager to multiply fortunes. But to understand where that capital actually ended up, you have to walk to the edge of the island, down to the Battery, and look out at the harbor. The story goes that a visitor from out of town was being shown the sights. His guide pointed to the water and said, "Look, those are the bankers' and brokers' yachts." The visitor looked at the magnificent ships, thought for a moment, and asked, "Where are the customers' yachts?" The answer, of course, is that the customers had none. Fred Schwed Jr.'s 1940 book uses this joke as a gateway to a rigorous deconstruction of market microstructure, exposing the stark mechanical reality of how Wall Street operates. Decades before Eugene Fama formalized the random walk hypothesis, Schwed articulated the same economic principles through the lens of human behavior. To see how this machine functions, we have to map its ecosystem. We will dissect Wall Street by examining its four pillars: the predictors, the intermediaries, the customers, and the institutions. The central illusion of the financial industry is that it exists as a fiduciary engine to build client wealth. Mechanically, it is optimized strictly for fee and commission extraction. The trap begins with language. When someone asks what the market is doing, the default answer is it is going up or it is going down. This framing implies momentum. If a golf ball is going up, the physical laws of propulsion dictate it will continue up for at least a moment. But the stock market is not a physical object. It does not obey Newtonian physics. There is zero statistical guarantee that the next tick will follow the previous one. Yet entire careers are built on ignoring this fact. Short-term order clerks try to guess the afternoon rally, while long-term forecasters draw complex charts predicting the next decade. Both are consistently wrong. Schwed points to a specific proof of this failure. When legendary, highly successful financiers die and their safe deposit boxes are opened, the executors almost always find bundles of hopeless, forgotten securities. Even the titans of the industry make massive, unfixable errors. Leading up to the 1929 crash, respected figures like Andrew Mellon advised that gentlemen prefer bonds right before the bottom fell out. Others called for a crash year after year, entirely wrong, until the exact moment they were suddenly right. Then there are the technical analysts, or chartists. They search for patterns in past data, double tops, breakaway gaps. Logically, staring at a jagged line of past stock prices to predict the future is identical to examining the last 1,000 spins of a roulette wheel to predict the next number. Because markets are complex systems untethered from physical causation, active prediction models amount to pure chance, carefully masked by industry jargon. If the predictors are guessing, what are the intermediaries doing? The traditional fortune-preserving banker possesses one critical skill: the ability to say no. The stockbroker, by contrast, suffers from a systemic compulsion for action. They are physically incapable of doing nothing. When trades resolve, the language adapts to protect the ego. If an asset rises, it was well bought. If it drops, it was well sold. The result justifies the action, after the fact. The actual skill required to acquire clients rarely involves financial acumen. Brokers gather assets by signaling social competence, playing a strong game of golf, mastering bridge, or relentlessly waiting to grab the next stranger. Wall Street accounting is chaotic because it confuses commissions with speculation. A floor broker might earn a steady $20,000 a year in clear commissions, only to watch the value of his seat on the exchange evaporate by $500,000 over the exact same period. Assessing true corporate value is just as murky. Schwed favors the department store owner's pushcart method of accounting. Locate the original pushcart you started with 40 years ago, verify it's still in the storeroom, and count everything else as profit. Schwed suggests a basic aptitude test for anyone entering finance. If a candidate doesn't understand why a roulette wheel with 2 zeros favors the house, or when to draw to an inside straight, they lack a foundational grasp of probability. The intermediaries do not guarantee their survival by generating outsized returns for their clients. They survive by prioritizing continuous transactional volume, ensuring the commissions flow regardless of market direction. On the other side of the trade are the customers. The absolute safest pools of capital, savings banks and life insurance companies, are legally barred by the government from trading on margin. But retail investors possess an intense attraction to margin. It is the financial equivalent of taking out a mortgage on a house you don't even own yet, risking total ruin just to chase a slightly higher yield. The comedian Eddie Cantor famously captured the reality of this leverage. He noted that his brokers told him to buy stock for his old age. It worked perfectly. Within a week, he was an old man. When the market turns and the margin call arrives, retail customers generally choose one of three responses. They yell at the broker and refuse to pay. They flee to the woods to hide from the telegrams. Or, worst of all, they desperately throw good money after bad. Take the case of a wealthy client with a $7.5 million portfolio. He gave his wife $1.5 million in ultra-safe Liberty bonds, making her swear never to return them, even if he begged, because it would mean he had gone crazy. 6 months later, the market crashed. He demanded the bonds back to cover his margin. Schwed diagnoses this pathology as rhinophobia, an acute psychological dread of holding uninvested cash. This fear forces customers to remain fully exposed at all times, ensuring they ride the market all the way to the bottom. There is also a spiritual element at play. Trading provides the psychological thrill of being a business proprietor, making decisions, managing capital, without actually having to do the hard physical labor of running a real company. Ultimately, retail ruin is rarely the result of overt broker fraud. It is driven by the customer's own rhinophobia, their greed, and their complete inability to tolerate inaction. So if individual stock picking is fatal, what about pooling money into an investment trust? On paper, the logic is flawless. Retail investors hand their cash over to a team of highly educated experts who provide professional management and broad diversification. Schwed uses a golf analogy to expose the flaw. If you could hire a professional like Gene Sarazen to hit your shots for you, you'd be a fool not to. But that assumes the professional actually possesses demonstrable skill. In portfolio management, that evidence is severely lacking. Even the core promise of diversification collapses under pressure. When the market breaks downward in a panic, correlated assets fail together. The entire diversified list drops as a single unit. Add to this the glaring conflicts of interest. Banking houses frequently use their affiliated investment trusts as a dumping ground for the undesirable securities they cannot sell to anyone else. Success in these institutions is often entirely accidental. During the 1929 panic, a board of directors was about to execute a ruinous stock purchase. As the order was being written, a 20-year-old clerk accidentally made a loud, rubbery noise of contempt. Spooked by the sound, the board canceled the order, saving the trust $750,000 through pure dumb luck. Options trading presents a similar trap for the institutional gambler. It appeals to rhinophobia by limiting upfront exposure, but it relies on a paradox. The buyer, the seller, and the broker all look at the exact same contract and simultaneously believe they hold the mathematical edge. Institutional vehicles do not magically eliminate risk, nor do they consistently generate outsized returns. Instead, they institutionalize incompetence, quietly layering management fees on top of the exact same human errors. It is tempting to look back at financial history and romanticize the boom periods, but those eras were defined by blatant market manipulation, organized trading pools, and fake volume designed to trick the public. In the 1920s, the luxurious club cars of trains kept crystal bowls full of free nickels for millionaires to use in the subway. It was the ultimate symbol of easy money, and it vanished overnight. It perfectly illustrated the extreme fragility of a market built on leverage. Regulatory bodies like the SEC step in to establish guardrails, but their task is nearly impossible. They act as a doctor attempting to cure an amorphous, uncooperative patient that actively resists treatment. There is a critical difference between theft and folly. Millions may be stolen, but billions are lost through foolishness. A burnt customer will always prefer to claim they were robbed rather than admit they were simply a fool following other fools. This is why systemic reform is perpetually disappointing. Legislation can mandate clearer prospectuses and outlaw wash sales, but no law can rewrite the underlying human psychology of greed and risk-seeking. Schwed draws a line between investment and speculation. Investment requires modest hopes paired with high probabilities. Speculation is the reverse, high return hopes tied to exceptionally low probabilities. The historically consistent strategy is mathematically sound, but psychologically excruciating. Buy when the crowd is absolutely terrified, and sell when they are euphoric. To do this, you have to separate price from value. Price is the clear, flashing number on the ticker. Value is fuzzy. It is tied to earnings, prospects, and intangibles. True wealth is not the fluctuating balance printed on your brokerage statement. True wealth is the ability of your capital to generate a sustainable, reliable income over time. Which brings us back to the harbor and the innocent question of the out-of-town visitor. The yachts belong exclusively to the intermediaries. They are paid whether the market rises or falls. Wall Street is a flawlessly designed wealth transfer machine, fueled by the statistical impossibility of short-term prediction and the inescapable, highly profitable flaws of human nature.